At this point, we are ready to conduct an exercise to make sure you understand the basic ideas that we've been covering. Below is a historical income statement as well as a projected income statement. These were the historical GAAP-based results as well as the analyst's forecast of those results without accounting for any non-recurring items or anything like that. The analyst basically looked at the revenue growth rate and said, I'm going to forecast a growth rate using the last 2 years worth of historical growth rates. So if the last 2 years worth of historical growth rates were 8.9% and 9.6%, they're going to take the midpoint and just use that as the going forward growth rate to get you revenues of 161 and growing. With gross profit margin, we're going to forecast gross profit margin using the last 3 historical years average. The SG&A margin, we're going to use the last 3 years historical margin to forecast. And then tax rate, same story. Now, we're covering this to walk you through what you'll see in a moment when we complete the exercise. And that is that if you just assume that these are the right historical numbers and you use historical results to frame your forecast, which many analysts do, you are going to now have an income statement that looks like this. You have EPS of 41 cents, 46 cents, and 50 cents. But if within these historical results, we found out that in 2011, cost of goods sold included within it a $14 inventory write-down. And then in 2012, an $18 inventory write-down. And in 2012, also SG&A had a $12 litigation gain. I'd like you to adjust this income statement to reflect the historical income statement on a non-GAAP basis, which excludes these items. And I'd like to, then we can analyze. So then we can actually analyze how, given that we're forecasting off of historical results and these historical results are about to change, how does that affect our, not only how does that affect our historical results, but we can then see how it affects our forecast results as well. So at this point, using the disclosures on the prior page, I'd like you to create a normalized income statement, both using the historicals and forecasts that reflect the elimination of non-recurring items. Assume that write-downs were tax deductible and the litigation gain was taxable at a 35% tax rate. I'd like you to fill in the blanks, and then I'd like you to answer the question, was it in management's interest to disclose the non-recurring items, all else equal? Hit the pause button. When you're ready, hit unpause, and we'll go over it together as a group. But give it a try on your own. It's going to take you a little bit of time, and then we'll talk about it. We're told that 2011 cost of goods sold has $14 in inventory write-downs embedded within it. 2012 cost of goods sold has an $18 inventory write-down, and then 2012 SG&A has a $12 litigation gain. So we're going to have to make some adjustments to these historical financials, these GAAP-based financials, and we're going to see how that affects our historical EPS, and then what we're going to forecast using the same methodologies for growth rates and margins that we did in the past, and we're going to see how that compares to the past EPS, forecast EPS results and operating profit results now that we've altered our historical. So let's get started. The first thing that we find out is cost of goods sold has $14 in inventory write-downs in 2011. So how do we exclude the impact of that inventory write-down? Well, the expenses are 17. Within it, we know that inventory write-downs from our basic accounting course, inventory write-downs are usually embedded within operating line items, quite often the cost of goods sold line item itself. And that's what we're saying is happening here. If it wasn't for that write-down, what would cost of goods sold have been? That's the way to figure out whether you need to add or subtract inventory write-downs. And the answer is, it would have been much lower. It would have been $14 lower. So we're going to subtract by 14. So cost of goods sold on a normalized basis is how we talk about it, excluding non-recurring items. We talk about the operating item post-exclusion as a normalized item. Again, we are removing the impact of a write-down expense. And remember, write-downs, the two corresponding entries are the inventory asset goes down by the write-down, and the corresponding entry is retained earnings going down via the expense. So we are eliminating that expense, pretending like that didn't happen, which makes gross profit higher. Right? Instead of a gross profit of 64, we now have a gross profit of 78. And that also increases operating income, and therefore that increases EPS from 26 240. That's the first adjustment for 2011. We're going to deal with the tax adjustments in just a moment, but for now, let's go through the nominal adjustments. We have an $18 inventory write down the next year. So it's the same story. We just subtract, instead of 14, we're subtracting 18, which of course raises gross profit and the EPS. But we also have, offsetting that, is a litigation gain. We want to exclude that litigation gain under the thinking that it is a non-recurring item. What would the SG&A expenses look like if we were to pretend like that lawsuit windfall didn't happen? We have to add the gain, not subtract it. Hopefully that wasn't too tricky. Obviously, the expense would be higher if the expense isn't being offset by a gain. And now what we have are much higher EPS figures for 2011 and 2012. Notice, by the way, they're also altering the margin assumptions. Margins are now much higher than they would have been on a GAAP basis. The last adjustment we have to make is to normalize taxes. And what does that mean? If we are pretending like this $14 million write-down didn't happen, we should also pretend like the tax benefit associated with that write-down didn't happen. Presumably, at a 35% tax rate, taxes would have been 14 times 35% higher. If you don't have an expense, you don't have a tax deduction. The next year, there are two things offsetting this. It's going to be 0.35 times the 18 inventory write-down, net of the $12 litigation gain. The litigation gain that you're pretending doesn't exist was actually adding to your tax liability. Well, now that's not there either. So there's a net expense of $6 that has to be reflected via slightly higher taxes that we're ignoring, basically. Oops. Oh, I forgot to put a multiplication sign here. So now that, of course, since taxes are a little bit higher for both years now that we've normalized them, it offsets the fact that normalized net income was a lot higher than it was on a GAAP basis. Now it's just a little bit higher than it was. And now we can build our forecasts. So we're going to forecast growth rate using the last 2 years historical average. So let's do that. Let's keep this simple. Gross profit margin, we're using the last 3 years average. Yeah, keep that. We're going to do the same thing with SG&A and the tax rate. And now what we're ready to do is forecast the new normalized income statement. We're going to do that as follows. Revenues, we're just going to take prior year revenue times 1 plus the revenue growth rate. For normalized cost of goods sold, the easiest way to do this is to actually calculate gross profit by taking the gross profit margin times the revenue. It's a little bit of an indirect way to do this. That gives us gross profit, and that way, if we take revenue minus that gross profit, we back into normalized cost of goods sold. Normalized SG&A, we simply take the SG&A margin times revenue. Operating income, we can actually carry over the historical calculation. That doesn't change at all. In fact, we can carry over pre-tax income historical calculations. Simply operating income minus interest expense, which was hard-coded as 5 throughout. Normalized taxes is going to be the tax rate times the pre-tax income. Last but not least, normalized net income, we can carry over the formula. That hasn't changed. And then EPS, the bottom line per share, we can carry over that formula as well. So I can actually go ahead and now copy and paste this, fill this through to the right. And now we can compare the EPS on a normalized basis, the net income on a normalized basis, not just historically, but also on a forecast basis. Notice the only thing we've adjusted here is we've excluded these write-downs and litigation gains, but it's had an impact on the forecast. Let me split the screen. And what you'll see is that historically, as you'd expect, EPS is higher on a normalized basis because we're excluding a whole bunch of expenses. Going forward, why should the fact that we've excluded historical expenses, why is that affecting the forecast? Notice here, EPS on a GAAP basis is much lower than EPS on a normalized basis. We calculated growth rates and ratios the exact same way that they were done in the past. The difference is that because the growth rates and margins are relying on historical growth rates and margins, notice the gross profit margin uses the last 3 years worth of results. Same with SG&A and the tax rate. That means that if you're excluding things from the historical gross profit margin, the excluding things from the historical SG&A, you're going to have different margin results for forecasts. And that's going to lead to different EPS and profitability estimates. And that's why it's so important to understand that when analysts are excluding these non-recurring items to turn GAAP results into non-GAAP results, this has very real consequences for forecasting. So the second question, beyond just normalizing these results, was to try to get at whether management has some sort of incentive or whether they have a preference for normalizing versus not normalizing. Recall that GAAP-based presentation is what they have to present. They have to present a GAAP-based income statement. These normalizations, in other words, when they sort of identify that there are non-recurring items and these things that analysts end up excluding, and sometimes management itself provides the tools to make those exclusions for normalization. The question is it in management's interest to do that? And clearly in the example that we gave here, we see that by virtue of us stripping away those inventory write-downs and litigation gains, the net impact is that EPS, as well as operating income, as well as net income, as well as if we were to calculate EBITDA or any other operating statistic, it does look more favorable on a normalized basis, and that's a fairly common thing, as we talked about in the prior video.